FX offers two products. The first one is a leverage product. It delivers leverage on ETH and BTC without funding costs, without borrowing costs. Users just pay a one-time opening and closing fee. And that's it. And in most cases, they won't have to pay any fundings. And the difference with regular CDP is that we abstract the looping. So we give overexposure to the collateral, and we have this very innovative liquidation mechanism that prevents any hard liquidation. FX protocol is an evolved CDP. Whenever people are longing the collateral, it involves selling the stablecoin for more collateral. Different peg-keeping mechanisms. The first one is that stability pool. On fx, the stability pool is a yield strategy that takes both fxUSD and USDC as base assets. Each time fxUSD is traded below 1, the USDC from the yield strategy will buy fxUSD on the market to put it closer to peg, and each time it's traded above 1, it's sold back for USDC and goes back to the stability pool.
Hey guys, I want to tell you about Gnosis, a collective of builders creating real tools for real people on the open internet. Gnosis has been around since 2015. In fact, it started as one of Ethereum's very first projects. And today it's grown into a whole ecosystem designed to make open finance actually work for everyday people. At the center of it all is Gnosis Chain. It's a low-cost, highly decentralized layer 1 that's compatible with Ethereum and secured by over 300,000 validators. So whether you're building a dApp, experimenting with DeFi, or working on autonomous agents, Gnosis Chain gives you a solid, neutral foundation to build on. But Gnosis is more than just infrastructure. It's also tools that people can actually use. Like Circles, for example, lets anyone issue their own digital currency through networks of trust, not banks. And then there's Metri. It's their smart contract wallet that makes it easy to access Circles, manage group currencies, and even spend anywhere Visa is accepted, thanks to their integration with Gnosis Pay. All this is governed by Gnosis DAO, where anyone can propose, vote, and help guide the network. And if you want to get involved, running a validator is super easy. All you need is one GNO and some basic hardware. To learn more and start building on the open internet, head to gnosis.io. Gnosis, building the open internet one block at a time. Welcome to Epicenter, the show which talks about technologies, projects, and startups driving decentralization and the global blockchain revolution. I'm Sébastien Couture, and today I'm here with Cyrille, who is a core contributor at FX Protocol. FX is a really interesting yield-bearing stablecoin that also utilizes a perps market. There's an interesting stability mechanism there that we'll get into. And also right now, I think it's like probably one of the best yielding stablecoins on the market, with their stability pool yielding somewhere around like 12-13%. So that's really sort of compelling and interesting. And I wanted to talk to Cyrille today about FX and understand the core mechanism, and also how they fit in the broader stablecoin landscape. So, hey Cyrille, nice to see you today. Thanks for joining.
Hey, thanks Sébastien for having me. It's a real pleasure to be here today.
So you're actually based in France. I see you got the Ethereum France T-shirt. What's your background? How did you get interested in DeFi? Have you worked at any of the big French protocols or yeah?
I started DeFi because I got wrecked with the crypto markets, and I figured I wanted to make yield, that getting yield on stablecoins would be somehow more predictable income than just betting on the market volatility. So, and I had a bit of funds on my company actually, and I went to the bank and I asked for yield opportunities to the bank. And as a professional in France, they would offer me 0.15% APR with a 6-month lockup. And I figured it's
0.15% or 15%?
No, 0.15. 0.15 with a 6
not 1%.
Yeah. So I figured it was a theft, and I should find something else. And I heard about DeFi at that point, and actually, what I didn't hear about DeFi, I heard about Celsius that was offering something like 8% and Nexo as well. And I started putting euro there at that time. And I figured, okay, how do these guys actually make yields? And this is how I heard about DeFi. And it was right after the DeFi summer. And I bumped into a French community called DeFi France. It's pretty close to maybe Lobster DAO, but for French people. And it's a group of DeFi passionate people talking mostly about DeFi and with zero bullshit. It's mostly doing about building stuff, and there's a lot of builders actually in the group. And I started by reading everything, every single message in that group for months, and I learned a lot of stuff, starting practicing DeFi as well, and getting involved into DeFi fronts by sharing what I learned from the community and organizing meetups in Toulouse. And I've organized almost a meetup a month for the past 3 years. I just stopped before this summer. And this is how I got to meet with people that came to the meetup to talk about their projects and stuff like that, and how I got people to reach out to me to get my opinion on different stuff. And regarding f(x), I did a meetup about f(x) in September 23. So right after the first iteration launch, I've been following AladdinDAO, which is the DAO behind f(x) and as well as Concentrator and Clever protocols. I've been following the DAO since the beginning, and when I first read about f(x), I just loved the design. So I figured I should make a meetup about it and shared it on the community, and this is how I started to contribute to the project.
Cool. I think like doing meetups is such an underrated kind of low lift thing that you can do early in your crypto journey. I organized a few meetups back in the day, Lille in the north of France. And like, yeah, I know like, Brian, my co-founder here at Epicenter, like also organized like quite a few meetups in Berlin. And it's such a great way to like meet people who, you don't necessarily see online, right? Like, but like they come out of the woodwork for the meetups, right? And it's like great way to build connection.
Yeah, exactly. And I believe it's one of these few ecosystems left in which you can easily access to people that make the ecosystem, and you can just give to the community, and it will just bring so many opportunities. Just by being genuinely sharing stuff, it just meet people, and it brings opportunity.
Yeah, I guess what I'm trying to say is like even like 15 years into crypto, there's still opportunity for people to like have meetups.
Yeah, exactly.
It's like
exactly.
like I would encourage anybody to do that. And like what's the relationship? Like, well, what is AladdinDAO and the relationship there? And someone was already working on fx before you started contributing to it, and
yeah, it's a good question. AladdinDAO is the DAO that builds f(x) protocol. So it's the same team basically. And Aladdin started as an investment DAO, something like 4 years ago, but it quickly created its first protocol to get what was missing to them in the DeFi landscape. So they launched. I wasn't there. I wasn't contributing there at that point, but I was a user actually. They launched Concentrator, I believe in 2021 maybe, or 22, and then Clever. So Concentrator in a nutshell is an auto-compounder protocol. So it auto-compounds your yields, but instead of compounding into the underlying, it lets you compound into another yield-bearing asset, such as Steve, for instance, or since Aladdin that has been very close with the Curve ecosystem in the first days, you can compound your CRV, for instance, instead of compounding stablecoins. So it's a protocol that lets you DCA with your DeFi farming, basically. And so that's the first protocol. It's still around with over 100 million TVL. And the second is Clever, that lets you leverage your CVX farming, basically, without liquidation. And so the first two protocols are very deep into the Curve and Convex ecosystem, while the third one, which is f(x), solves the problem of decentralized stablecoins, basically. And what I've loved about the design is that it brings a real decentralized alternative into the stablecoin landscape. And it was the origin of f(x) is actually the USDC depeg in March 23, because AladdinDAO with the existing two protocols had a treasury mostly made of USDC. And they just figured it's such a nonsense to build DeFi on the most decentralized infrastructure, and to rely on centralized stablecoins, and to depend on TradFi events such as the SVB failure. And this is how the idea of f(x) was raised in the first place, and it evolved to what it is today. And today we managed to bootstrap fxUSD to over 100 million market cap as well, while having no VC funding, while doing things 100% organically.
Yeah, no, I agree that like it feels like such a huge failure on the part of the ecosystem. Sometimes I think like the fact that centralized stablecoins have dominance over the stablecoin market feels like a pretty big failure on the part of proponents of decentralized tech. And it's really unfortunate that protocols like DAI and other decentralized stablecoins haven't picked up more adoption than they have. I mean, like, there's sizable adoption, right? But it's nowhere near where USDC and Tether are at. I mean, there's like a lot of regulatory risk there, and also DPEG risks and these sorts of off-chain risks. What is like the kind of core value that you think, or the core tenets that a decentralized stablecoin protocol should embody? Like, if you had to kind of put characteristics on what like an ideal decentralized stablecoin protocol looks like, what would those be?
Yeah, I think for a decentralized stablecoin to work, people need to trust it, to be reliable. So it needs to have a good peg, obviously, and to be liquid enough so that you can come and buy it and sell it in size. And it needs to be collateralized so that the peg actually stays. So it's not just liquidity, but it's actually a good peg by design and good backing. And it also needs to be scalable. It all goes back to the stablecoin trilemma. It needs to be, in my opinion, mostly on-chain, because so that you can abstract trust from it and just trust the code instead of trusting entities and people. And that's and it also brings censorship resistance with by being on-chain. So that's all these different key components, I guess, that makes a good decentralized stablecoin. In my opinion, the beauty of Ethereum and decentralization is that it abstracts trust. And abstracting trust from finance reduce the risk, right? And it's just like people just forget about this, and just like the TradFi is used to trust and to have someone to sue if anything goes wrong, and while we can just avoid trusting people using Ethereum. And in my opinion, it makes a lot of sense to embrace that technology and to bring and this is actually what we do with f(x). We manage to deliver higher risk with that's higher rewards with lower risks, because there's no trust involved. And in my opinion, that's a paradigm change that will come at some point with when most of the new TradFi guys will be crypto native and understand that value proposition.
Yeah, I certainly hope so. I mean, like, there's a centralized stablecoins have a lot of tailwinds. So and they have. I think like for that to happen, I mean, it could happen. It could happen that like decentralized stablecoins take over, but there would have to be some catastrophic event that like really erodes the trust in like Tether or USDC to the point where decentralized stablecoins can kind of like come in and start taking that. I don't know that I think that decentralized stablecoins can like slowly start creeping up and building up issuance to really surpass in a meaningful way the main centralized ones.
I don't think they will take over because the centralized one will probably always be more convenient and scalable. That's a fact. But I also believe that centralized stablecoin will all eventually disappoint at some point. And at that point, people will need a reliable alternative to use. And why would you use a more risky stablecoin, so a more trusted stablecoin with low risks, while you can most of the time use a decentralized one with higher higher yields. The idea is just to offer a reliable alternative, and this is what we're doing, and looks like people understand it since the protocol has grown pretty well lately.
Yeah, that makes sense. I think also maybe there's still like some lingering fear about decentralized stablecoins, right? Like where with UST, so that might also contribute a little bit. I think also just generally like they're harder to understand, right, than like a centralized stablecoin. Like centralized stablecoin, people know like, hey, there's an institution behind this. There's all these banks. There's like KPMG audits to say the money's there. I get that because that's like the model that most people are familiar with. With the decentralized stablecoin, like you have to listen to hour-long podcasts like this to like understand what the fuck's going on. And
exactly. But again, it goes back to that trust paradigm of the old world in a way. But yeah, definitely there's a PTSD of UST, and in lots of people I meet, and when the first question they ask about fxUSD is it an algorithmic stablecoin? Because they heard about this.
Yeah,
it's dangerous. And no, it's fully collateralized with exogenous collaterals, decentralized stablecoin.
Cool. Yeah, well, let's maybe get into a little bit of how it works. And like the first time we chatted, you described it as sort of an evolution on the CDP model that Maker introduced to the world, I guess back in like 2016. So maybe using that as a, if that's helpful, using that as a comparison, because I think a lot of people have that model and understand that model. Yeah. How does it work and what are the different components?
Yeah, for people used to the CDP model, it's the easiest way to understand how FX works. It's indeed an evolved CDP design in the way that so FX offers two products. The first one is a leverage product. So it delivers leverage on ETH and BTC or BTC. You can choose directional leverage without funding costs, without borrowing costs. Users just pay a one-time opening and closing fee, and that's it. And in most cases, they won't have to pay any fundings. It can happen in very rare occasions, but so it brings predictability in the cost. And the difference with regular CDP is that we abstract the looping. So we give overexposure to the collateral, just like if you would use a CDP with looping protocols such as fxSAVE or Contango or stuff like that to get directional leverage. We abstract it. We include it into the product. So that's called X positions for the longs, S positions for the shorts. You get directional leverage up to 7x, predictable cost, just a one-time fee. And we have this very innovative liquidation mechanism that prevents any hard liquidation. So you don't get the half or 100 or the entire position wiped out with if the market goes on the opposite side. And you get this very progressive liquidation that keeps you as much exposure as possible and reduce the risks. So on the leverage side, in a way, it's a zero stress leverage. It's just a Zen perp, if you want, using the CDP model in the backend.
Okay, so maybe we'll stop it there and kind of go over those different parts yet. Right. So comparing to the CDP model, CDP, you borrow against collateral, but leverage isn't included in the protocol. Typically, people get that leverage by going through some external protocol like fxSAVE or maybe InstaDApp, and they're kind of exporting the looping functionality to that protocol and then bringing the collateral back. Yeah, it's a huge pain in the ass. Like I've done this, it's just really painful and kind of scary to do. So like, and then you bring the collateral back, and then you're doing this loop, and you may like get some leverage from that. FFX has this built in, so you can do up to 7x leverage. And then the other part that you mentioned is that there's a gradual liquidation mechanism, which means that your collateral isn't liquidated in sort of a single transaction. It's more
it's very progressive.
is progressive, right? So, and I guess I've never thought of this, but like, what makes that possible, and why is it that typically lending protocols don't have a progressive?
It's a very good question.
Liquidation mechanism.
Yeah, thank you for asking this. Why the other CDP don't do this is because most of
or
them,
just lending protocols, basically, like,
yeah,
why wouldn't
yeah,
Aave kind of have this,
most of
progressive
them
lending mechanism?
can't do this because they handle each leverage positions individually. So to make the liquidation profitable, it needs to be large enough so that the keeper, the liquidator, will actually be profitable by handling the liquidation. And the main difference with f of x is that all the leverage positions are handled together based on on price ticks, basically. So we aggregate every positions at risks together to process the liquidations, meaning the liquidations are profitable even if the individual liquidation is very small. So to illustrate the design, if you're familiar with the LTV concept, each time your leverage position crosses 88% LTV, the protocol puts it back at 88% LTV, no matter the amount it represents, the dollar amount, the dollar value of the liquidation, so that your position never reaches 95% hard liquidation LTV. If that process ever fails and your position reaches 95% LTV, at that point, the whole position is liquidated. So, but in most cases, it shouldn't happen because, it works.
So you're kind of socializing the liquidation mechanism. Is
Yeah,
that like a
exactly.
right way to look at it?
Yeah, it's a good way of saying it. Yeah, it's socialized.
Okay, interesting. And no other DeFi protocol does this, like a lending
Uh,
protocol?
yeah, recently Fluid came up with a similar approach. They have this whole base liquidity layer, but it's a way bigger machine, because it's a whole lending protocol and DEX and so on. It's on the FX side is way simpler. It's just two collaterals and a CDP, but they have a similar approach in a way. The main difference on their side is, I believe, is that the liquidation penalty can fluctuate, while on f of x it's fixed 2.5. On Fluid, I believe it goes from 1% to 8%.
Okay, so maybe just to put this another way, say we compare with Aave, like Aave, each position can be liquidated, has to be liquidated individually to protect the underlying collateral. Here, the underlying collateral is kind of pooled to represent all of the positions, and so, that collateral is going to secure your position as much as it's going to secure someone else's, and the different positions may have different sort of collateral ratios relative to the overall collateral, which is where you get this kind of socialization mechanism. So someone else's collateral is kind of like backing your position, right?
Not exactly. Your position is actually like your position collateral ratio is monitored. So there's no you're not actually. Each long position has its own collateral, but it's all pooled together, and all the leverage positions are monitored together. So and instead of liquidating each position individually, you look at what's at risk on each position, considering the current price, and you liquidate everything all together. Is that easier way?
Yeah, I think that makes more sense. Okay. And what kind of complications does this because there's always trade-offs, right? So like what's the sort of trade-off of this approach?
Regarding other lending liquidation design or even CDP, I think it's just better because it enables a higher LTV. This is how we managed to deliver up to 7x, while on Aave, for instance, you would get like 5x stops on ETH or BTC. It's because it gives us, like, by liquidating way more progressively, it's more secure in a way.
Right. But are there like unintended trade-offs, like For example, like the fee, the fees you can charge are lower, or like liquidators are less efficient. Like there must be some trade-off, right?
On the liquidation side, no, I don't think I can't think of any trade-off here. It's actually a more efficient way of doing things. No, I don't think of any trade-off on that side. Actually, the cost of the liquidations is like the liquidation penalty, which is a keeper bounty. It's actually the same. It's way lower than on other money markets, for instance. If you compare with Aave, when you get liquidated in Aave, I believe it's at least 5% penalty or maybe 10, and the liquidation LTV on ETH or STEEF is something like 80%, while it's 88 on fxX. And when you get liquidated, you can get up to 50% of your position instantly repaid. That's a hit, on fxX, it can be as small as just 0.1% of your position wiped out. If the price just touches it and goes up again, you don't get wiped more. And the penalty is just 2.5%. Regarding other CDPs or money markets, it's way more secure and efficient, and it brings like a relief in terms of how you see liquidations. To compare with a regular centralized perp, it's still, since it's on chain, it's the liquidation LTV, even if it's a progressive liquidation, is still lower than on a centralized perp, because like liquidations are processed with a 99.5% LTV on Binance, for instance. But it's just a different approach, It's
And so with this approach, you have near 100% capital efficiency. Like borrow to lending is nearly 100%.
No, it's still over collateralized, but since it's more efficient, we can have a lower overall collateral ratio than on other CDPs. So it's more capital efficient than previous CDPs. It's still obviously less scalable than a centralized stablecoin, obviously, because it's over collateralized, but still it brings a better compromise than anything before.
Okay. I'm looking at their website. It says that $4 billion, almost $5 billion have been liquidated last month on other perp solutions, and FX has 0 liquidations.
Yeah, because like the hard liquidations only happened once. It was in the first days of the current iteration of the protocol, and there wasn't enough keepers processing the liquidation break, so that some position reached 95% LTV and got liquidated. But since that event, it was on February the 2nd or something like that, there was a massive liquidation event on the market. And since that date, there was no hard liquidations on FOX. Some got partially reduced in a way, but there was no hard liquidations. And the main point of this design is that the leverage users keep as much exposure as possible to recover with the market if the market ever recovers. If they made a bad trade, it won't save them. If the market just crashes and goes to zero, they will go to zero. But way more progressively than on any other on-chain leverage solution.
And another thing you mentioned is that that there's no funding rate for the leverage trades. You just have this one-time fee.
Yeah, that's correct.
What's unique about this approach? What does it enable?
It has been done before by Liquidity, for instance, with LUSD. It was similar in a way. People would just pay a one-time opening fee. But the main difference here is that CDP, like LUSD, couldn't scale because they had massive peg issues. Like the LUSD peg is not reliable enough to actually hold LUSD, because you end up buying it at 1.05 and selling it at 0.99. So it's not reliable enough. And we fixed this by still having this just fixed one-time opening fee and closing fee, but we only add a small funding if the stablecoin is ever depegged. And that funding is, and just like most of the fees generated by the protocol, are distributed to a stability pool that acts as a peg keeper to attract more USDC, earning that organic yield, and helping with supporting fxUSD peg. So we have this organic peg keeping mechanisms that just work and that lets fxUSD scale pretty well since we launched early this year.
Yeah, let's talk about that stability mechanism, the stability pool, and then there's also, I think, like I guess fxSAVE is
it's
also related here.
Yeah, correct.
Yeah, so like what's really impressive here, I think, is the yields, which range between like 10 and 20%. Now, those approach Terra level, anchor level yields, but yeah, why is this sustainable? How is this sustainable?
It's a good question. Yeah, indeed, fxSAVE, which is the main yield strategy on the fx protocol, since we launched it, has been one of the best stable yield in DeFi. If you look at the dashboard created by Inverse Finance called stableyields.info, you can compare all the main yield-bearing stable strategies around, such as fxSAVE, obviously, SDollar, Stake USR, SCRV-USD, sUSD, and stuff like that, and most of them. And if you look at this on different time frames, you see that fxSAVE has been above all the time, and like the next one is like 4 points below fxSAVE, and that's a huge success for us. We're very, very proud of this, and the main thing is that most of this yield is 100% organic and doesn't imply any human active management. It's 100% smart contracts on chain. There's nothing to trust else than the code, and so to understand how it works, maybe I can break down the peg keeping of fxUSD. So if you understand that FX protocol is an evolved CDP, whenever people are longing the collateral, it involves selling the stablecoin, right? Because in the backend, the stablecoin is sold for more collateral. So it brings selling pressure. And this is why, for instance, LUSD ended up under peg, or the people getting leverage on liquidity ended up being redeemed because LUSD was massively sold. And we solved it with different peg keeping mechanisms. The first one is that stability pool. On fx, the stability pool is a yield strategy that takes both fxUSD, the decentralized stablecoin, and USDC as base assets. And it acts as a peg keeping mechanism. Each time fxUSD is traded below 1 on the main liquidity pool, which is on curve against USDC, each time fxUSD is traded below 1, the USDC from the yield strategy will buy fxUSD in the market to put it closer to peg. And each time it's traded above 1, it's sold back for USDC and goes back to the stability pool. So that strategy keeps fxUSD peg. And to attract capital, the incentives comes from all the fees generated by the protocol. At the moment, the protocol generates close to $1 million a month, and most of it is distributed to the stability pool or the governance token lockers.
Okay, so just to stop there for a second. So the protocol does rely on USDC, at least in the stability mechanism, to find its price.
Yeah, it's not backed by USDC at any point, but like USDC is the like if you wanna any asset on chain to be pegged to USD, it's pegged to USDC or USDT, and actually on chain USDC is the most liquid. So this is why USDC currently is the most liquid DeFi stablecoin around.
Right.
So if you
is it safe to say then that like this mechanism it wouldn't be possible without an on-chain stablecoin that has a really high peg stability?
The other option would be companies that could handle their redemption with real dollars, for instance. But yeah, since we don't want to rely on, I guess the biggest company that does this currently is Circle and Tether, but the most liquid on-chain is Circle with USDC.
Right.
So
Okay.
that's
Interesting.
currently the obvious choice. At some point, if we scale fxUSD enough, we may not need it anymore, and people will build liquidity with fxUSD because they want to be paired with fxUSD. But when you build a stablecoin, if you want it to be liquid and at peg, you need to build liquidity with. Currently, the most obvious choice is USDC.
Right. And so if there was a USDC depeg, highly unlikely, but like it's happened before, right? Like what
It happened before, and it actually triggered the creation of FOX. If the stability pool cannot accept USDC, like the USDC peg is monitored, and if it ever depegs, the stability pool won't accept any more USDC. So it's exposed but protected from USDC depeg. So you get exposure to both assets, fxUSD and USDC, but it's protected from any USDC depeg. So the main risk here in that strategy for any LP is the fxUSD spec. And this is why there's different layers of peg keeping. The first one is the stability pool itself. And so the yield comes from the protocol economic activities. So people taking leverage, they pay this one-time fee I told you about. They can have in some situation funding, and I'll go through this in a second. And most of the leverage positions are backed by yield-generating assets such as wrap-staked ETH, and that yield also goes to the stability pool. So if it's not enough, so actually whenever fxUSD is traded below 1, it's actually below 0.998, the stability pool buys fxUSD the market. But if there's not enough USDC into the stability pool, so whenever the ratio of USDC goes below 5%, we may not have enough USDC to support the peg. So in that very situation, all the leverage positions get a small funding cost applied to their position. It's temporary, and it's here to support the peg. And that funding cost is the RV borrowing cost of USDC. And that goes to the stability pool to attract more USDC deposits that will support the peg and then cut the funding, because as soon as the distribution of USDC goes above 5% again, then the funding is off. But if it's not enough, there's different layers. You always have to anticipate what could go wrong. If it's not enough and fxUSD starts to depeg for too long, it means when the EMA 42 minutes of fxUSD on curve goes below 0.998, so it's pretty small depeg, but long enough to be noticeable, we trigger what I call the depeg mode. And in that situation, people can no longer open any long positions. So it prevents any further selling pressure on fxUSD. And at that point, a second layer of funding is applied to the leverage positions, which is way higher. It's 5 or 10 times the USDC borrowing costs. I don't believe it happened yet, because the previous layer of peg keeping have always been enough. But in that situation, it brings a very high incentive for leveragers for either leveragers to repay to close their loans, because they can buy fxUSD cheaper and close with a bigger profit, and they can avoid these high fundings. If they keep their longs open, then it brings a very massive yield to the stability pool, thus attracting USDC that will repeg fxUSD quickly and cut the fundings. And there's one last layer of peg keeping mechanism, which is the redemption. When fxUSD is in depeg mode, people can buy it and redeem it against the collateral minus a 0.5% redeeming fee. So that sets the worst case scenario peg at 0.995, basically.
One question here, I'm looking at the stable yields dashboard, which is great, by the way. And the yield, the 30-day average is almost 6 points above the second position, but only has less than half the TVL. And if you look at Athena has 5.7 billion in TVL with also about the same 30-day average. There's about 100 million in TVL as we're recording this on September 3rd. With yields so attractive and a mechanism that appears to be sustainable and sort of safe, why in your view, why isn't there more TVL on FX?
There's probably different reasons for that. First thing is that we are doing things 100% organically. There's no VC backing, so we don't get it. We had to make all our connections ourselves, just by reaching out to people and meeting people into events and stuff like that. And the overall protocol TVL is over 400 million now, and it's been built 100% organically. So it takes time to build, as you said it previously, it takes time to build trust towards a decentralized stablecoin. So for people to actually understand that the team won't rug pull, that it's actually secure, and that there's the liquidation mechanism works, and the pay keeping mechanism works, and so on, and that the yield will also be sustainable. The stablecoin will be liquid enough so that people can come and exit in size and stuff like that. It takes time to build that, and we've done that, and we keep doing it and reaching out to getting in touch with more and more people. But I guess it takes longer when you're doing this just organically and without any massively backed token TGE event to come and stuff like that, because the token has been liquid from scratch with fixed emissions over the next 50 years. And it's probably less speculative in a way than other VC-backed projects. And then obviously Athena is not exactly a DeFi product. It's highly centralized and relies on centralized fundings, which makes it obviously more scalable. And if we were having 5 billion right now, the yield wouldn't be that high. But it's what we observed over the past few months and scaling the protocol to over 400 million is that it actually scales by growing progressively. The more TVL there is into the stability pool, the more leverage activity we observe on the leverage side, and the more fees we collect. And when you look at the collected fees over each month, it's pretty clear that there's a pattern of stabilizing these fees and having them way more steady over time and growing steadily. I don't know if I exactly answered your questions. I went to all different topics, but I guess doing things organically without VCs and 100% on-chain, it's the probably harder to scale a protocol that way. But in my opinion, and our mission with fxX and AladdinDAO is to build stuff that will last for decades, if not centuries. And so yeah, we're here for the long term.
Do you think that, like, with the track record now that you've built this TVL and a peg that has held and kind of demonstrated that this works, do you think that it would be useful to now go and like raise money to accelerate growth, to accelerate fundraising into the protocol, marketing, etc.? Is that something you considered?
We don't consider raising money from VCs because but people are free to buy the token on the market, and if people do, it actually helps because there's other strategies which are incentivized with the token, but it definitely helps. On one side is that when we talk to new funds and stuff like that, and it's way easier now that the stablecoin is more liquid and the protocol is bigger than in the beginning. So it helps to raise in a way stable TVL for the stability pool, because the more TVL there is in the stability pool, the more volume we can process on the leverage side, because it keeps. And so yeah, it helps on and we've definitely seen the difference. For instance, we were discussing it with Paul, another team member that went to ETHCC with me this year as well as last year, and we've seen a major difference between the two editions in how people were interacting with us. Like when we were talking to people and other builders like last year, we felt like they were things. Oh, that's interesting. Let's see how it goes, And now it was mostly, wow, guys, congrats on the growth. And it's way easier to build partnerships when people already heard about the protocol and start trusting it.
So I wanted to switch gears a little bit. You guys published an article a couple of days ago on your Twitter. It's Ethereum security model and strategic importance of decentralized stablecoins. Yeah, give me a gist of like what you're arguing for in this article, and how you're thinking about Ethereum security long term.
Yeah. So yeah, the idea of the article was to point out that the value secured by Ethereum and in centralized asset mostly, which are real world assets and USDT and USDC and stuff like that, is going so high that at some point these guys, and today it's Tether, tomorrow it could be another entity, has a major weight into the protocol security. For instance, if there is any hot fork tomorrow for a new update, for instance, and that major centralized entity doesn't want to support it, what's going to happen, And by supporting all these centralized entities, we make that possible. It may not be a technical issue, because obviously it's very hard to compromise the proof of stake, but it could be a political issue at some point, and an economic issue. And the idea is not to say, as I told you earlier, that we should replace centralized stablecoins with decentralized. But the idea is that we want to make sure that there's always an alternative that you can use in most cases, and just use centralized solutions when it's absolutely needed. And I like to compare decentralization with privacy, for instance. It's not white or black. It's not binary. You cannot be totally private and anonymous on internet. It's a scope, and I know people decentralization is a scope is some kind of a meme, but it's actually true. You do your best. You just do your best, and if you can use private product in most cases. Like let's say for search engines, you can use DuckDuckGo most of the time, and if you don't find the answer, then you'll go on Google, and it's actually better than using Google all the time and giving them all your private data. And I think it's pretty much the same thing. If you can achieve what you want to achieve with your stables using a decentralized one, there's no point in using a centralized one. So if you can get better yields while staying decentralized, you should just do it. And whenever you want to off ramp, because today on off ramp goes through centralized solutions, then you can go with the centralized solution for that very moment. But I guess that's the main idea of what we wanted, the message we wanted to pass with that article.
I mean, I think it makes sense to kind of promote the use of decentralized stablecoins, but like, yeah, as we were saying earlier in the conversation, it's like, at this point, USDC and Tether are so ingrained. It's like, it almost feels like a little bit like Ethereum's Achilles heel, that we've built. Like the ecosystem has built all this amazing decentralized infrastructure only to recreate kind of similar systems that exist in TradFi. And yeah, it's not clear like what the solution is there to kind of mitigate for this as a space.
Yeah,
Yeah.
I think it's a shame, especially when there are actual reliable alternatives. It's always a compromise between uh, um, decentralization and conveniency. If it's convenient, if it's not convenient, you won't do it. It's just like ecology as well is very similar. People won't recycle if it's a pain to recycle. If they can just do it very easily, they will do it. And um, as it and now that I believe we brought a design that is convenient, reliable, secure, and with attractive yields, then why using anything else?
Hmm. Yeah, one other thing I wanted to talk about is kind of where FX sits within the broader perps landscape. So, you guys are competing with Gearbox, and GMX, and Hyperliquid, and DYDX. And it's a market that's very dynamic and that's changing all the time. It's like 2 years ago, DYDX was, sort of leading that market, had a lot of traction, and now that's sort of lost prominence. Now everyone's kind of focused on Hyperliquid. Um, and I think there is a big part of that is driven by incentives. That's also like driven by capital, and like Hyperliquid has a lot of money. How do you guys succeed in that space and maintain relevance long term when we know that like really well capitalized projects like DYDX have lost prominence in such a short period, and who knows, maybe Hyperliquid in 2 years from now is like totally irrelevant and something new came along and is much more interesting.
Yeah, maybe we don't know. Yeah, I think we mostly do our own uh, path in that market, in that very competitive market, as you stated. By We have our own blue ocean. I don't know if you heard about that book, but it's like we have our niche market in a way because we're not exactly a perp, we're not exactly a CDP. We're kind of in between, delivering zero stress leverage. And for many people, getting a leverage position just is a headache. They don't sleep well and they are very nervous and they get liquidated. We've seen that James Wynn guy getting liquidated all the time. I mean, if that guy had been longing or trading on f of x, he would still be rich. And we bring a solution to these guys basically.
I don't know who that is, but I feel his pain.
Yeah, it's a guy on X that shares his trades, and people just observe. And there was another one, a fund. I don't remember the name. And these guys just keep getting liquidated on Hyperliquid. And I've seen there's even a meme saying hyper liquidated. That's a good one because the other thing is that on all these semi-centralized solutions, there is more risk, and on the Hyperliquid side there's a massive trust me bro stuff on the Oracle side, and we've seen it recently. People got liquidated for no reasons on, I don't recall what ticker. It cannot happen on f of x. Everything is 100% on chain. there's no there's no
Well,
there's
I mean,
very very few
to play devil's advocate here, like you know, there is kind of an oracle, and that oracle is the US, is like the treasury bonds that are like backing the USDC, that are backing the USDC peg, right? Because that's a mechanism that enables the stability pool to function. So I think like, sure, there's no oracle and there's maybe no centralized oracle, but there is a reliance on some centralized thing that.
Yeah, of course, f of x relies on Chainlink as an oracle, just like all DeFi. And obviously, we were talking about Tether being a Damocles sword for DeFi earlier, and Chainlink is another one, obviously. But yeah, there is a reliance on Chainlink on f of x. And on USDC spec, yes and no, not exactly, because as I told you, like for instance, the stability pool and fxSAVE, which is built on top of the stability pool, is protected from any USDC
Okay, maybe not vulnerable, but it relies on the price, on that price feed, if you will. Like that's kind of the equivalent of a price feed.
Yeah, but we
Yeah.
believe that so far Chainlink is the most secure and reliable Oracle provider. And if Chainlink fails on the ETH or BTC Oracle, I guess f(x) is going to be the list of your problems.
Yeah. Yeah. It'd be great to have just like a simulation where that happens, just to see, like, how we just all get rugged.
Like a DeFi dystopian story.
Yeah. Just like build the simulation where, the Chainlink Oracle price for Ether BTC just goes off haywire, and then what happens?
Well,
Um,
I don't
yeah.
have because I'm not the technical guy in the team. I don't recall the exact Oracle design, but if I recall correctly, there's different safeguards in the Oracle design on f(x).
Looking to the future, like Ethereum aspires to secure hundreds of billions, trillions in RWAs. Like stablecoins are becoming a large part of the kind of crypto narrative. Institutions are hopping on the stablecoin sort of train. I think we all kind of anticipate a proliferation of stablecoins, with many branded stablecoins. Like PayPal is just like one of many, I think, that will come. What are the opportunities here, I think, for us as an ecosystem, and where does f(x) fit in there?
Yeah, so again, a very good question. We actually already see opportunities, and I think I will also answer in a different way one of your previous questions regarding how we can compete and why the TVL is lower than Ethereum, for instance. These products, since they are not hardcore DeFi in a way, they're CDeFi stuff, they are already institution ready. They can talk to institutions, and they can build, they can sign contracts, actual legal contracts, not spot contracts, with these guys, and so that these institutions can deploy capital. And for instance, Usual scaled like crazy by onboarding capital that had no idea about crypto in the first place. That's crazy. They managed to scale to 2 billion, if I recall correctly, with people from all around the world that had never done any transaction. And as a DeFi protocol is way harder, because these institutions don't want to hear about this, and hopefully there's solutions now, and there's new protocols filling that gap between OG DeFi in a way, and institutions. And we're currently working on a product with different partners, such as Lagoon Finance, Nine Summit, Nexus Mutual, EPC Custody Solutions, to build a tailored product for institutions, so that institutions could harness the fxSAVE yield in a very safe way. And you're actually the first person I talk about it publicly. The idea is to call this fxSAVE, because it would be the fxSAVE without the DeFi risks, all created and institution ready. So that's a way to embrace the arrival of institutional money. And the other way is all these new stablecoins you mentioned. I don't really see them as competitors, because most of them are very attracted with our organic yields, and some of them are already harnessing them. Many of these new yield-bearing stablecoins are made of other yield-bearing stablecoins on harnessing on-chain or off-chain yields, and they actually use fxSAVE or stability pool in the backend. So they contribute to our growth in a way. So it's not just centralized solution versus decentralized solutions. There is a synergy between the two words, and it's actually good, because in the first places I could see it in the good guys and the bad guys way, but it's actually we can build synergies, and these guys can help us build the alternative to what they're doing.
Well, that's a great note to end on. Cyrille, thanks so much for spending the time on Epicenter today. And yeah, looking forward to seeing FX go up and to the right.
Yeah. Thank you very much for having me. If you enjoyed that episode, feel free to join the AladdinDAO Discord. It's a very open community. We all started by popping up on the Discord and asking questions and sharing ideas about the design. So it's always a pleasure to meet new people and discuss things, discuss DeFi between passionate people.
Great. Thanks, David. Cheers.
Thank you very much. Bye.